right, and we are live. And Mark, are you in DC? Is
I
that where
am
you?
in Washington, D.C.
Okay, there you go.
Are
So
you in Ohio, or you just have the big
I
O
am.
Washington?
I'm heading right. It's the second this ends. I'm getting in my car with my crew, and we're heading to Game 3 of the ALCS.
Nice,
Tribe
nice.
Yankees. So here in Cleveland, it starts at 5:08 Eastern tonight. So
My chief of staff at FHFA, John Roscoe, is a big Ohio guy, so
oh, okay.
you should definitely get to meet him.
Oh, very cool. Very cool. So excellent. And I see a bunch of people filtering in. We'll give everybody another 30 seconds or so, and then we'll go ahead and get started. Rob, where are you at this fine afternoon?
I'm in Vancouver, Washington.
Oh, Vancouver. There you go. Looks very picturesque in the background there.
It is very pretty, autumn colors and so forth. It's an interesting play here between Oregon and Washington because the one state has state income tax but no sales tax, and the other state has income tax but no sales tax. Whatever I said, it's the opposite. So it's important to live in one place, but if you're going to buy a
Shop in the
washer
other.
or a dryer, you go over the border.
All right, let's go ahead and get into it. My name is Rich Swerbinsky with Onward and Upward Consulting. This is the big picture. Thank you for joining us today. Really special guest. We're super excited to chat with today. And first, I'd like to introduce, as always, my esteemed colleague and co-host this week in Vancouver, Washington, Rob Krisman. Rob, how you doing today?
Good. It's a brisk autumn day here. Good for college football.
Good college football weather, that crisp fall weather, and
Although don't all the West Coast teams now fly east because that's where all the conferences are?
yeah, it's crazy. You got like USC playing, yeah, games at Rutgers and crazy crap like that. So it whole new world. So this week, our special guest, very excited and pleased, he was able to join us, the former director of the FHFA, senior advisor at the Cato Institute, former chief economist for former VP Mike Pence. It is Mark Calabria. Mark, thank you so much for joining us today.
Rich, it's just such a pleasure to be here, and also with you, Rob.
Cool. So much good stuff to get into. But Rob, I always start with you. And, there's, before we bring in somebody much smarter than both of us, we've got 18 days till the election. The VP went into enemy territory on Fox News yesterday. I'm sure you caught that. The 30-year fixed rates are back in the high sixes. I know how much you love that topic, almost as much as politics. You got Rohit Chopra on the warpath, as I predicted. I predicted the Rohit Chopra warpath, and we're getting it right into November. Any of that, Rob, tickle your fancy? You ready to endorse yet? Anything for the masses right out of the gate here?
No, I'm still on the fence, Rich. I'm still on the fence,
Okay.
just like tens of millions of Americans are still on the fence. They don't know who they're going to vote for.
Well, you're not in the swing state, so it doesn't matter. So
That's true.
yeah.
Isn't Nevada? I mean, I'm a Nevada resident.
That's
I think
true.
Nevada is a swing state.
It
It
is. It's
is.
in there.
It
Yeah.
is.
So, but no, we've been talking about this darn election since the last election. It's and even then, the morning after. So, Mark, I was telling Rich that, even like when I was a kid, somebody would concede the election and phone the other party, and there would be congratulatory messages, or certainly the decision would be made that night. But in this election, it just seems like it's not going to be decided that night. Or
Rich, I'm tempted to blame you guys in Nevada.
right,
If there's
right.
any state that I don't think they'll have it counted, it'll be Nevada. No, I agree. Is the broader point, however you think it should turn out, it's just a deep embarrassment as a country that we can't actually decide elections on the day of elections. And, the fact that there's a good chance we will be a week after the election, still not know the outcome, is really just an embarrassment.
Yeah. So, yeah, Rich, getting back to your question, it'll be interesting, of course, to see how the tides of mortgage banking and residential lending rise and fall with the outcome. But I wanted to ask Mark, Mark, so I've been in this business for some decades, and when somebody says to another person, well, I'm an underwriter, you know generally what an underwriter does, or I'm a loan officer, so you know what a loan officer does, or an account executive, or whatever it might be, even a CEO. You kind of know what they do. But there aren't too many other people on this call who have been FHFA directors. And I wanted to ask you, for the benefit of me and everybody else, kind of what's a day in the FHFA director's life? Are you off meeting with the chairman of the Federal Reserve or the president, or beating up Fannie Mae or Freddie Mac, or hosting an Easter egg roll on the lawn, or
There you go.
what are the days like?
So, I mean, let's starting with the observation that a little more than half of my tenure was during the pandemic, and where my life was like everybody else's. I sat at my kitchen table and worked from there. But let's talk pre-pandemic. So, we certainly at that time were an independent regulator. So our interactions with the White House were somewhat minimal, although we were planning an exit from conservatorship, and Treasury was kind of a partner. So for me, the face of the administration for me was the Treasury Department. I met with Secretary Mnuchin, probably almost once a week, talked to them pretty regularly. But most of my day was very internal focused. Would start out with my senior team. What are the things we have to deal with? Certainly would meet with Fannie and Freddie executives, never together, but generally separately on a pretty regular basis. And of course, that's the job of conservator, is a separate job from being regulator. You often do I guess I certainly should emphasize, if you run a federal agency, you spend a ridiculous amount of your day just signing your signature to pieces of paper. Of course, I like to actually read what I was signing, so I probably took a little bit more time than others in that regard. A lot of staff briefings. I tried to keep my travel to a minimum. Maybe I left Washington and spoke at a conference like, say, MBA or something like that, once a month. We did a fair amount of meetings, particularly on the front end with stakeholders, mostly trade associations, but, frankly, anybody who really wanted to come in. A lot of time with the media trying to describe what we were doing and minimizing, I think, a lot of uncertainty and questions about, what is exactly does an exit from conservatorship mean? What are the other issues we're dealing with? What's going on in the housing market? And of course, that kind of ramped up in the pandemic as well. So you do a lot of press outreach. But fundamentally, and I think it's easy to forget, without going into too much detail, you gentlemen may remember that I inherited an agency where my predecessor was somewhat under a cloud of scandal for some personal behavior. We had some very big morale problems at the agency. So one of the first things I needed to do really was spend a lot of time with the staff. And I would also say my management style is to be seen. I think you need to be out there in the trenches, if you will, with your staff. We did a lot of town halls. I pretty regularly, at least once a week. We would have a kind of a lottery, if you will. You could get to sign up, and at least once a week, I had lunch with a dozen of the staff. In fact, I remember saying to my chief of staff, John Roscoe, again, a good Ohio boy, I said to John, by the time I'm out of this job, I want to have met with every person at the agency. And obviously pandemic kind of forced us to take that online. But I'm proud to say, out of a 700-person agency, I had conversations with 675 of them by the time it was all done. And it really is a reminder that when you're in a leadership position, it's really everybody else who does the work. And the degree to which they are passionate, committed, and excited about the work, that's your job to energize them. And I took that part very seriously. So spent a lot of time with staff, did town halls at Fannie and Freddie, spent a lot of time meeting with management. So you do spend tremendous amount of meeting, but it's also so that you can explain the direction. And I look at it this way. My objective was that the executives at Fannie and Freddie, the staff at FHFA, that 95% of the time, they didn't need to ask me a question. They already could deduce what my answer was going to be. And for me to be able to do that with them, had to spend a lot of time explaining where I was coming from, answering questions. And of course, she spent a lot of time with Congress, did a lot of Hill meetings, both sides of the aisle, both sides of the Hill, spent a lot of time with members. So again, a lot of meetings. And you also just I'll wrap it up by saying, the primary function of the head of an agency is to be the external voice and communicator with the agency. So you are spending a lot of time with external audiences. So I hope, Rich, that um, gives you some description.
Yeah, that was excellent. And Fannie and Freddie, let's I guess go there next, Mark. And you know, obviously, this is a huge part of the mortgage industry, and so certainly a lot of interest in the mortgage industry world about, you know, regardless of who wins the election, you know, direction that the agencies could go. And I want to get more into some of the groundwork you laid to privatize the GSEs that could be picked back up potentially if the Trump wins in November. But if the Trump administration were to win in November, how likely is it, do you think, that they would prioritize privatization of the GSEs? And like, what would that timeline look like? Would they need Congress to do it? Take us inside that world.
Sure. And let me, and I don't want to, I'm an economist by training, not a lawyer. So if I sound like I'm perhaps splitting hairs on some language, it's because I think the language is important. So first of all, let's keep in mind, they never stopped being private. The conservatorship is essentially an administrative bankruptcy. So just as in 2020, when Brooks Brothers and Hertz entered bankruptcy, they didn't become part of the government. They continue to be private companies that needed to be restructured. And that's really the legal situation with Fannie and Freddie. They continue to be private companies today. And like a bankruptcy judge is supposed to clean them up, that's what the agency is supposed to do. Now, there's no need for Congress to do anything. As a reminder, I actually worked on Capitol Hill in 2008 and helped draft the statute that created the agency. And we 100% modeled it on what FDIC does. So just as last year, when Silicon Valley Bank failed, our Signature Bank, our First Republic Bank failed, and the FDIC cleaned them up and put them back out, that's 100% what the agency is supposed to do for Fannie and Freddie. That's the model. To me, one can have a broader debate. Why is the current administration doing that then? And that's a great question, but they're legally obligated to do that. But again, you have to remedy the situation that caused the conservatorship to begin with, which gets to the point about, what in a Trump world, what would happen. So let's keep in mind that it takes a while to get personnel in place. So my view would be it'll take you 6-7 months in 2025 to get a new FHFA director confirmed by the Senate. Obviously, as Treasury Secretary coming in, who would be the voice for the administration on policy in this area, they're going to have tax reform to deal with. They're going to have trade issues. They're going to have sanctions issues. And we saw this in 2017. I remind you, I was at the White House and I would regularly go to my friend Stephen Mnuchin and I'd say, why can't we do something on GSE reform? And his response would be, Mark, I got taxes I'm working on. I got trade I'm working on. And so it's a roundabout way of saying it will be a priority for a Trump administration, but it will not be a top 5 because the top 5 are really going to be taxes, trade, and these many other issues, which I actually should remind folks do have a big impact. So for instance, on the trade side, as a reminder, when you and I buy goods from China, we give them dollars, and a lot of those dollars that China has flow back into buying Fannie and Freddie debt. And if we ultimately are successful rebalancing the trade relationship with China, that means less dollars will go into Fannie and Freddie debt, and perhaps more dollars held by China will go into soybeans. And that will change the demand for agency MBS. But that's a whole different other topic. But there are trade and international implications that feed into demand for agency MBS, as well as, of course, the Federal Reserve either selling off or purchasing agency MBS. So to get to the question of what do I think the timeline will be, I don't think it's a 2025 event because there are a number of things that still need to be done for Fannie and Freddie, but I think it is completely doable by 2027, assuming you don't have a downturn in the housing market, a downturn in the stock market. One of the things we were looking at pre-pandemic was doing a public offering to accelerate the exit. Because remind you, when I walked in the door, Fannie and Freddie were leveraged 1,000 to 1, so not in good financial health. And again, it wasn't my job to relitigate how they got there. My job was, this is the hand I'm dealt. How do I fix it? How do I get them out? Now they're in much better shape. I think they could actually potentially exit by 27 or 2028 without a capital raise. But again, those numbers, are in flux and we have to update those. If you do need to do a capital raise, obviously, you need to get underwriters, you need to do road shows. You also need to make sure that the systems are in place. So, for instance, something that concerned me in 2019, as a reminder, Fannie and Freddie were not 34 Act filers before 2008. That is, they weren't covered by Sarbanes-Oxley, for instance, until 2008. And so while I'm not an accountant, my parents were, but that doesn't make me one necessarily. But my layman's view in 2019 was I did not think the companies were Sarbox compliant. And if we were going to do what would have been the largest public offerings in history, we needed to hire a lot of accountants and we needed to get a lot of things in place. So, and of course, we also needed to get the agency in place. My view was in 2019, FHFA was not ready to be a regulator again outside of conservatorship. The conservatorship had dulled kind of in a sense, what the agency had developed over time was the easy way in its mind to do things. Instead of, as a regulator, you do a notice, comment, rulemaking where you get feedback from the public, and that could take 9 to 12 months. The agency got in the habit of, we'll just call up Fannie and Freddie and tell them to do X as conservator. That's not the way it's supposed to work for public policy. And so we had to go through a process. So, for instance, maybe the best example of this, we finalized a rulemaking over new products and programs for the GSEs. Of course, maybe the most talked about recently is the Freddie second mortgage product. Well, when I got there, that process was completely done via the conservatorship, not via done regulation, despite the fact that Congress had told the agency in 2008 to do it via regulation. So we had to go through and work out all these procedures where we were asking ourselves, okay, are we doing things as a conservator that we're actually supposed to do as a regulator? And how do we hardwire that and do it the right way? And that was a considerable process. In my mind, there's still a number of things that need to be undone, need to be done and finalized. There need to be significant changes made to the UMBS, which we can talk about if folks want, but that's not ready for an exit. But all that said, the important part is it's all doable. This isn't, this isn't some impossibility. The mechanics have all been worked out. We spent a lot of money, Houlihan Lokey, other, Fannie and Freddie had Wall Street advisors. We spent a lot of money. We spent a lot of time. There are plans on the shelf. The decision trees have been mapped out. Not every decision has been made. Questions about if you were going to do an equity raise, who goes first? Do you do them both at once? All these are important questions we went through. And the point being is all that's on the shelf. And so to me, it is doable. I think the primary consideration is whether you have the personnel in place. So for instance, I was involved in bringing DeVito on to Freddie Mac. Obviously, we've got a new CEO at Freddie. We've got a new CEO at Fannie. I would put it this way. When I started as FHFA director, the boards of the companies were overwhelmingly what I would call big dollar Democrat donors. That may not be the same people you want to have if you're going to go public. So for instance, we recruited an SEC commissioner for the Freddie board so that we could help get their financials in place. And so we recruited a number of people like IT experts. And so certainly any new administration would come in and want to ask, are these the boards and are these the executive teams? And I'm not making a judgment either way. I don't know the answer to that yet. But I would tell you any team would come in a Trump administration and ask, are these the teams you need for these to be companies back out in the marketplace again? And that would take time. That would take process. And my guess would be probably a third to half of the board would be, both companies would be replaced. You've got to do recruitment on those issues. But again, the bottom line is all of this is doable. All of this has been laid out. I think to me, the more interesting question is there's a really good chance that by, say, 2027, 2028, that even in a Harris administration, Fannie and Freddie may have sufficient capital to put them in the position where they could exit. And so does the Harris administration simply ignore that? I think to me, that's part of the interesting question. But at the end of the day, the more important things are you are in a position where they can get out with the right things that's put in place. It's doable in a short number of years. And it's more a question of will than it is of mechanics.
No Congress, though. Congress would not be needed to.
I mean, you don't. So let's start with just like last year. Congress did not vote on SVB. Congress did not vote on Signature Bank, and so that's the structure. Now, one of the reasons that I don't think that you would see an acceleration in 2025. So let me put it this way. When I became director in 2019, Treasury Secretary Mnuchin reached out to me and said, Mark, we're going to go to Capitol Hill and we're going to get them to reform all of this. And, they're going to pass a limited targeted guarantee on the MBS. And I said, Stephen, I went through this pre-2008. I don't think it's going to happen, but I will go up there and I'll make the case with you and I'll fight the fight. And needless to say, probably about 8-9 months later, Secretary Mnuchin basically says to me, okay, you were right. Congress is not going to do anything. Now, the important part here is I think any new Treasury Secretary is going to want to go through that themselves. I think they will go through an effort to try to figure out what us Washington veterans kind of know. Congress just doesn't want to, there's just too many trade-offs. And there's too much political risk in this for an elected official. And I think many of them, some of them don't even see a problem with the status quo. So, and obviously it depends on who you have in place. If the Republicans pick up the Senate, you've got Tim Scott will be the new chairman of the banking committee. And, a lot of members don't have history with the issue. When I got confirmed in 2019 via the banking committee, as a reminder, I was staff and left that committee in 2009. In the 10 years I had been gone, over the 21 members on that committee, only 5 were still there. And what that means is you have very few members of Congress who remember pre-2008 Fannie and Freddie. And so for many of them, this is a whole new set of issues. And so the education campaign to get members of Congress there who are naturally risk averse in this area because they don't want anything to happen. So this is a roundabout way of saying, I think the chance of Congress doing anything big on GSEs outside of a crisis is extremely small. And therefore, the question really facing FHFA is, well, you've gotten directive already. Do you move forward without that? So now we can talk a little bit about perhaps what's the most, important from an industry contentious issue around that question, which is what is the nature of a guarantee? So Mnuchin wanted to go to the Hill and have a limited guarantee put on the MBS so that any other debt was unsecured and would be at risk. And we also figured you would raise a substantial amount of capital in front of the MBS. And of course, that the companies would pay for that themselves. You'd pay some sort of commitment fee for the guarantee, either like, what works with Ginnie or it works with FDIC. So as I said, it just strikes me as highly unlikely that Congress is going to do that. So what's the world we're in today? Now, our hope was we're unlikely to get a guarantee from Congress. So what can we do to get as close as we can? And if you can think about this, either two lenses. You could make something risk-free to the investor via door number 1, which is the taxpayer takes the risk, or you could get as close as you can via door number 2, where you created a capital stack in front of the investor where the risk is pretty minimized and that you've increased the quality of the assets. And I think a useful point of reference when we were doing the capital rule, PIMCO, which as you know is one of the largest holders of agency MBS, submitted a comment letter, and in PIMCO's opinion, they didn't show their math. I really wish they had, but their opinion was you would need 12% in the capital stack in front of MBS for them to consider that MBS to be equivalent to an explicit guarantee. Now, my view is, again, since they didn't show their math, that's a bit of an exaggeration, but let's take that as a ballpark. So where were we trying to get? The capital rule would get us about 4% capital. And then we assumed that we would build out about 4% debt that could be bailed in. So this was an MBS. And of course, I should add, our view was what really determines mortgage prices are MBS spreads. And so ROE on the debt, on the equity, borrowing costs for the unsecured debt, those would flow through maybe to profitability, but they weren't necessarily going to affect mortgage rates. So we were going to build out essentially a capital stack of debt and equity that was about 8% that would stand before the MBS. And then we would also, when we were actually doing this, we would tighten the credit box to where the mortgage were essentially rock solid. And I should say one of the very pleasant surprises to me as FHFA director was how rock solid most of the book is. So in 2019, 70%, 70% of the Fannie and Freddie book would probably perform in an apocalypse. Asteroids could hit the planet and 70% of the book is probably going to perform. And again, another 25% would perform under many circumstances. So the problem with the Fannie and Freddie credit quality is really about 5-6% tail. And so if we could kind of trim that tail, and we could build a capital stack in front of the MBS. And of course, we also recognize you were never going to advertise this, but we recognized in all likelihood, were there disruptions to the mortgage market that the Federal Reserve would buy agency MBS again. So, I guess it's a roundabout way of saying, is that equivalent to 100% guarantee explicit? No, but it gets you in the ballpark. And it gets you as close as we could get given the constraints we were operating under. So it's another roundabout way of saying, if you work in Washington for a very long amount of time, you recognize that you very rarely have good choices. You just have to figure out what's the least bad choice. And that's what we were trying to structure. And we thought we could get pretty close. And that's what we were working toward.
So Mark, how do you deal with people who say, well, if Harris wins or Democrats control Congress or whatever it might be, just leave well enough alone.
So I think
the system isn't broken. Let's just let them do what they're doing now.
I mean, my argument to that would be the system is broken. And I think it's extremely broken. So it's broken a number of ways. And we saw this in 2008 before the conservatorship, but we saw this in the spring of 2020 as well, where spreads shot up in a crisis. And you saw this, for instance, in the early months of the pandemic. So, December 2019 till about March to February 2020, investors were moving into MBS as a flight to credit. But starting in late February, when things really started to get bad, investors were dumping MBS. So the problem, in my view, is you almost have, in my view, the worst of both worlds. You have a situation where in normal environments, nobody cares, who cares about a guarantee? It's the market's going up. But you have the situation today where in times of absolute stress, investors dump agency MBS and move into treasuries. So the fact of the matter is, when we hit really tough moments of stress, nobody believes the guarantee. And they're probably right not to, because it's not actually there. So to me, I think the status quo is not a good thing. Of course, the conservatorship itself has politicized. So I would say this for the mortgage industry. Do you really want a world where underwriting standards shift every 4 years, if not more regularly? Where the pricing for mortgage credit becomes a political football on a regular basis? I would pretty regularly say to the GSE executives, I look forward to the days where these aren't my decisions to make and you get to make them as businesses again. So I do think, we aren't, I don't think that people broadly appreciate just how politicized the conservatorship has made the GSEs. And I think that's a bad thing for the industry. I think it's a bad thing for the taxpayer. And I think getting these companies back to where they act and behave in a commercial fashion, and they aren't just political footballs, is the best thing for the industry. So what I would broadly say is the status quo is broken. Just because it's not, just because you aren't seeing it now, doesn't mean it's not there. And again, I had these same arguments with people before 2008. Why do you want to wait till a crisis to fix this when we can fix it ahead of time? And again, you really can see this in a crisis where it becomes more difficult. And, I don't think people appreciate. And another good example of this. So, as I like to call it, the, widely beloved and much heralded adverse market fee that was put in place in 2020. And why was that put in place? Because Fannie and Freddie came this close to failing during COVID because of the costs of supporting the market. And so my point being is that if we'd like to avoid a situation where Fannie and Freddie have to actually raise prices in a crisis, then we have to get them in better financial shape. So to some extent, to me, whether you think there needs to be an exit from conservatorship or not, it's almost a secondary question, because all the things you'd want to do to exit a conservatorship are all the things you'd want to do anyhow to make sure these companies are a source of strength for the marketplace. And again, like I said, when I walked in the door, 1,000 to 1 leverage. There's no way you can be a source of strength when you're that highly leveraged. And again, I think a lot of people assume that the status quo provides a guarantee. It does not. There is no legal guarantee behind Fannie and Freddie debt today. And so to me, we're rolling the dice, assuming that'll continue and that market participants will continue to look at that as such. So to me, again, it is a system that has a lot of, rot, if you will, in the timbers, and I'd rather have us fix it when we can. So, as President Kennedy used to say, the time to fix the roof is when the sun is shining.
Fascinating insight. And, and it's so, it seemed like at the end of Trump's term, you and he they were getting really close. Like,
We
and the
were.
industry started freaking out because of their fear that, rates would go through the roof if, the GSEs were taken out of conservatorship. But in an attempt to kind of sum this up, it sounds like what you're saying is that, if a capital stack is kind of built to help assuage the buyers of MBS, that that it wouldn't lead to that. And on top of that, privatizing truly the GSEs would lead to a market where underwriting conditions stay more consistent. Politics don't come into the GSEs. I mean, a lot have surmised that if the vice president wins, that she could use Fannie and Freddie as tools to help.
Yeah, I mean, we have all these conversations today. There are significant parts of the left that want to have Fannie and Freddie impose rent control on Fannie and Freddie apartment buildings. Is that what the industry wants? There are significant efforts. I mean, you guys look at it now when you're trying to underwrite a loan. Well, how do you price a loan when you don't necessarily, if it's a home affordable product, so you have all of these grids of complicated pricing that are, engineered often for political purposes. And so I do ultimately think getting the companies out of conservatorship will help depoliticize them in a big way. Now, as you mentioned, and again, I should note a couple of just empirical facts. So in the time before between the 92 Act, when a new regulatory regime was created in the conservatorship, MBS, agency MBS to Treasury spreads are actually about 20 basis points tighter than they've been throughout the conservatorship. And in fact, since I've left, those spreads have actually increased by about 50 basis points. And so one thing I would say is, I think it's important to keep in mind that the argument that the conservatorship has reduced mortgage costs is an assertion, and one that I don't see a lot of data to support. In fact, the fact that you can look to the Europe and you can get cheaper mortgages to, a 20-year mortgage in Germany is half the cost of a 30-year mortgage in the US today. So it's just a roundabout way of saying, it's not clear to me that our pricing in the mortgage market today is good for the consumer or the industry. And so I recognize, I mean, it's certainly right to be risk averse and to, the devil, is certainly an attitude that many of us, I think, rightly kind of take. So I appreciate that. And certainly that's why I said, when I first became director, we spent a tremendous amount of time talking to stakeholders, talking to press, and we were really trying to walk people through. And again, it's a reminder as well. You may remember early in his career, when he was at Goldman, Secretary Mnuchin was an MBS trader. So you had a Treasury Secretary who knew the MBS market really well. I know the policy really well. And between the two of us, I think we were really trying to deal with the problems. And again, we spent a lot of time talking to people in the market, underwriters, when we really did want to make sure, what are the things that we're missing? How do we make sure we correct for this? But it's like a lot of things in life. If you're going to demand 100% certainty, then you're not going to end up ever doing anything. And for us, I mean, I guess I put it this way, I often describe myself as an Article 1 constitutionalist. And what I mean by that is Congress is the one who really makes these decisions. And so Congress has created a framework where they're expected to be fixed and gotten out. We went to Congress pretty regularly and said, listen, this will take us 2 to 3 years. If you want to make something different, great, do that and we'll do that. But to me, I really kind of looked at it with the view of my job as FHFA director was not to decide the big questions. My job was to carry out the mission that Congress had tasked me with. And not to really say, okay, well, Congress must be crazy for doing this. It's like, no, that's not my job. That's their job. They were elected. I wasn't elected. So I do think some of this is a degree of where in a leadership position, a regulatory position, you kind of have to start out with that view of, it's not my job to second guess Congress. It's my job to do the job they've given me. And that really was to fix the companies and get them out. So again, I thought we could do it in a way, and I think you can do it in a way where it minimizes the risk. But the bigger message for the industry is we reduce our odds of something going sideways if we do it in a period of relatively calm, rather than if we're forced to have to resolve this in a crisis.
Yep.
Hey, Mark, you said something interesting at the beginning of the conversation where you would meet with Fannie Mae and Freddie Mac, but never together. There's talk out there. Do we need Fannie and Freddie? Should we have a third agency? How would their competitive landscape look under continued conservatorship or under, removing them from conservatorship? Do you have any thoughts on that?
A great set of questions. And I'll start out with just simply reminding folks, Fannie and Freddie are not exempt from antitrust laws. So they're not allowed to coordinate legally. So the same laws that apply to Google or anybody else apply to Fannie and Freddie. And I would argue they clearly apply to the conservatorships, because as a good reminder, there's not a conservatorship, there's two, one for Fannie, one for Freddie, and they're not legally allowed to coordinate. So again, you have these fundamental differences. And I would argue that there are things that have been done under this administration that, in my view, violate the antitrust laws. And I think that that's a problem going forward. Now, it's interesting because I would occasionally have people at the White House like Larry Kudlow say to me, Mark, why can't you just combine them? And I would say, Larry, I'm not unsympathetic to that, but Congress created two, and Congress created both of them subject to the antitrust laws. So the question of whether we should have one or two or three or four or five, those were fundamentally questions for Congress. But since I'm not in that regulator job anymore and I'm allowed to pontificate on whatever I think we should do, we regularly asked for charter and authority when I was director. I think that it would be better for the marketplace if we had, say, 5 or 6 of them. Let's start with I think the benefits of scale are modest. Like maybe if you combine them, maybe you would lower mortgage rates 6-7 basis points at most. So I don't think the benefits of scale all that much. I do recognize that on one hand, combining them and having fewer of them allows there to be more uniformity across the mortgage space, so that you're not having to figure out, what are these 10 different products? How do these different procedures exist across companies? But the flip side of that is you reduce innovation. So to me, these are the trade-offs. It's like you can have 1 or 2 companies. And again, FHFA to me is a bit overly obsessed with alignment between the companies. As a reminder, pre-conservatorship, Fannie and Freddie really were 2 different businesses. They had different risk appetites. They had different business approaches. And I guess, let me put it this way, I start from the perspective that, in life and in business, a lot of the time you don't know what the right answer to the question is. So how do you create a process to get to the right answer? And you do that by having different strategies. And so to me, if we had 5 or 6 different GSEs, you could allow, this one could specialize in this type of lending. This one could specialize in this type of lending. This one could experiment without risking the system. So I think having more competition and more choice would bring more innovation to the industry. I guess I kind of put it this way. And again, as a reminder, my PhD is in economics. I was not taught that monopolies and duopolies are known for innovation.
Yeah, we see that now with, whether you talk about non-QM lenders,
Oh, yeah.
investors, FHA, VA. There are alternatives, and it is interesting to watch the spread, say, between non-QM loans and qualified mortgages, and see how that behaves over time and how that is impacted. You mentioned spring of 2020, basically a lot of the non-QM investors, for lack of a better term, went away or seriously reduced their appetite. And that was a wake-up call for the market to say, okay, could this happen again? And we don't want that.
Yeah. And I think that's how do you, and so the bigger takeaway is whether you have, 1, 2, 3, 4, 5, 6, they all need to be start out from the premise, well regulated, well capitalized. Now, again, if you have 5 or 6, then you can have 1 or 2 get in trouble without bringing down the system. And this is the tension in that, to me, I feel like our existing system is we've put all of our eggs in one basket. And diversification to me, is I think an important aspect there where you really want to make sure, that you have alternatives. And again, I think it's just highly risky to base everything on a particular model.
Mark, the regulatory side of the business, always something our industry watches as the election approaches every 4 years, which way the pendulum's going to swing. And yeah, just wanted to get your thoughts. The cost to originate a loan in America is still incredibly high
Crazy.
and really, really tough for independent mortgage bankers to make money, to profit. Your thoughts on just where the regulatory side of the mortgage business is at right now, and regardless of which side wins, which way that could go over the course of the next 4 years.
I mean, it's unfortunate that maybe it gets a little better, but a lot of the Dodd-Frank changes that were put in place, have really made it extremely expensive to originate a mortgage, and of course have reduced the incentives to do small dollar lending. I mean, good luck trying to get a $40,000 mortgage. And so I don't really see a big appetite. I mean, I think the window to revisit Dodd-Frank is unfortunately closed. I don't see a lot of political appetite for that. I do think there are some things you could do with CFPB that would bring some greater certainty to the process. And some of this, of course, is ultimately as you make it more complicated, to service loans and you make it more complicated to foreclose, that's ultimately going to end up entering costs of the consumer. And I think this is the part that Washington often misses, which is if you add a bunch of costs that look like they're benefiting the consumer, well, ultimately it's the consumer that pays those costs. And I don't think that that is widely recognized. So I'd love to have a more optimistic message about like we're gonna be able to get down the cost of closing a loan, but I see very little evidence to be optimistic on that front. But that said, I think a change in leadership at CFPB would bring a little bit different stance. I do think one big difference, and again, let me start with I'm proud of what we did in the pandemic, and we took the right approach in terms of forbearance, but it was never meant to be open-ended. It was never meant to be endless. And there really is this very big, difference of philosophical view. I mean, obviously, we see it foremost in the student loan market where, one party believes you shouldn't have to pay your student loan debt. Well, I mean, there are contingencies in Washington who basically think there should never be any foreclosures. One of the things that's stunning to me, pre-2008, the average amount of time from last payment to a foreclosure was about 270, 280 days. It is now on average 1,000 days by the time someone makes a last payment, by the time they're foreclosed upon. And so that's basically, we've created another 2 years of free rent. Somebody's got to pay it because nothing's free. Just like student loan debt, it may sound like it's free forgiven, but somebody pays for that. The taxpayer pays for that. The rest of us pay for that. And so I do think of this approach of nobody should ever be foreclosed upon is extremely costly. And again, I don't want to minimize. I mean, I had 2 close relatives of mine in the Great Recession go through foreclosures. They suck. It's a bad thing. But as I put it, while every foreclosure is a tragedy, a bigger tragedy is have a system where you're not allowed to have any foreclosures. And so we do need to deal with many of the compliance costs. And I think the real tragedy here is I don't really see a lot of benefit being added with all these compliance costs. So I think there's some real fundamental problems. CFPB is at the heart of a lot of it. Dodd-Frank changes are a lot of the heart of it. And again, I think we'll get a difference in enforcement stance, but I don't think we're going to get a fundamental difference in approach.
As always, the time flies by, Mark. So glad you could join us. One last question. If the former president were to win and were to tap you on the shoulder, your old role, would you be interested?
I think I would make an excellent ambassador to the Bahamas. So
Bahamas and
I think Rich already snagged that one, Mark.
There you go. I believe in public service. I don't feel a strong desire. I mean, I don't like unfinished business, but you know, at the end of the day, there are a number of people who could finish what I started at FHFA. There's a roadmap on the shelf. Certainly, if asked to do it, I would have, I mean, hard time saying no to a president, but it doesn't need to be me.
So much good stuff was in
Thank
the
you.
chat.
Thank you
We
very
couldn't
much.
get to all of it. We tried to incorporate as much as we could into the questions, but Mark, just fascinating insight on the inner workings of FHFA and the GSEs and what could lie ahead in their future. And I just really want to thank you for joining us this afternoon.
Yes,
Well,
thank you. Thank you very
Rich,
much.
Rob, thanks for having me, and thanks for everybody, you know, dialing in. There's a path here, so I really appreciate it.
And
All
to
right.
our attendees, we do this live every Thursday at 3 p.m. Eastern on Zoom. If you're listening on podcast or watching on YouTube, go to chrismancommentary.com and get registered for the live version of the show. And we've got some great guests coming up these next couple of weeks and had a great one this week. Thank you again to Mark Calabria.
Yes, thank you, Mark.
To Rob Chrisman and to all of you for joining us. And we will see you next Thursday at 3 Eastern on The Big Picture. Take care, everyone.
All right. Bye.
Thanks, Mark.